Hi everyone, I had to start reading this market today from scratch. Knowing what I know about Apple's earnings, Nvidia's strange reaction, Nebius buying inference talent, Reddit's sudden profit story, and this memory boom that almost nobody outside semiconductors wanted to talk about until it was already obvious, I would do one thing differently. I would stop asking which stock moved the most today? That is the wrong question. The better question is, what is the market finally admitting? Because most people are still looking at this like a normal tech tape. Apple beats, Reddit rips, Nvidia hesitates, AMD runs, memory stocks explode, Meta buys another AI team, and everyone says, well, that was a busy day. No, that is not what this is. This is the market trying to price a new industrial stack. Devices at the front, ads and social platforms in the middle, chips underneath, memory behind the chips, data centers behind the memory, and software sitting on top of all of it, trying to turn giant spending into real profits. Today is Saturday, May 2nd, New York time, and comment below what day and date you're watching from. And if you value this kind of market breakdown, support the channel by subscribing and comment John A.G. Best. So let's get started. The first piece is Apple, because Apple just did something very important. It reminded the market that boring is only boring until the cash flow shows up. Apple posted its best March quarter ever, with revenue around $111 billion, strong growth across every geographic segment, a new iPhone March quarter record, another services record, and more than $28 billion of operating cash flow. Now, does that make Apple the most exciting AI company on earth? No. Let's not get carried away. Apple still has a real question around AI. It still has to prove that its devices can become more useful, more personal, and more intelligent, without just adding another shiny feature that people forget about after a week. But here is the thing. The core machine is not broken. People were acting like Apple was finished because it wasn't screaming AI every 5 seconds. Then the company shows the installed base is still growing, services is still compounding, and the iPhone is still pulling demand. That matters. But inside that good quarter, there was a quiet warning. Memory costs are becoming a problem, and that is where this whole story starts to connect. Because Apple sells devices, but the AI world is fighting over the same components those devices need: DRAM, NAND, high bandwidth memory, storage, advanced chips, packaging, power, cooling. Suddenly, memory is not some boring cyclical corner of tech anymore. Memory is the pressure valve for the entire AI build-out, and if memory gets tight, somebody pays. Maybe Apple pays through lower product margins, maybe customers pay through higher device prices, maybe data centers pay because they need capacity no matter what, but somebody pays. That brings us to Nvidia, because Nvidia had one of those moments where the stock action looked disconnected from the story. The company's latest fiscal year was enormous. Revenue was a bit over $200 billion. The last reported quarter was around $68 billion, and data center revenue in that quarter was a little over $60 billion. Gross margins were still in the mid-70s. These are not normal hardware numbers. And yet, on a strong tech day, Nvidia can still trade like investors are bored. Why? Because Nvidia is no longer being judged as a great company. It is being judged as the center of the AI economy. That means expectations are already massive. The market is not asking, is Nvidia important? Everyone knows it is important. The market is asking, how much perfection is already in the price? That is a different game. So when AI demand accelerates, Nvidia does not automatically get a celebration. Investors ask whether that demand is durable, whether margins can hold, whether customers start using more custom chips, whether AMD takes more share, whether cloud companies reduce dependence, and whether the next generation keeps the lead. And this is where I think both sides get lazy. The bears say the stock dipped, so the AI trade is done. No. The bulls say AI is huge, so valuation doesn't matter. Also no. The real answer is more annoying, which is usually how markets work. Nvidia is still one of the most powerful businesses in the world, but the price has to keep being earned. Now let's talk AMD. AMD is real. The data center story is real. The AI accelerator ambition is real. The customer demand is real. But when a stock starts moving like everything is already solved, you have to ask a basic question. Is this a great company at a fair price, or a great company at a price that assumes no mistakes? Because those are not the same thing. AMD can win and still be expensive. Nvidia can be larger and still look cheaper on quality if its margins, ecosystem, software stack, and data center pull are stronger. That does not mean AMD is bad. It means comparison matters. And in semiconductors, comparison is everything. Now, Nebius is a different type of story. Nebius is not trying to be just another company with GPUs plugged into a building. That is the low imagination version. The more interesting version is that Nebius wants to own part of the inference layer. It agreed to acquire Eigen AI, an inference and model optimization company, to strengthen its token factory platform. The point is simple. Training gets the headlines, but inference is where the money gets spent every single day. It is the output, the response, the token, the cost per request, the speed users actually feel. If you can make inference faster and cheaper, you are not just improving the product, you are improving the economics of AI. That is why this acquisition matters. But let me be clear, it does not remove the risk. Nebius is still a high-growth AI infrastructure name. These stocks can show huge revenue growth and still disappoint because expectations are wild, spending is heavy, customers are concentrated, and the market can wake up one morning and decide it wants profits instead of promises. So the deal is interesting, the strategy makes sense, but it is not a free pass. And now we have Reddit, which might be the most surprising business story in this group. Because Reddit is messy. Let's just say it. The product can be chaotic, the culture can be intense, the conversations can go in every direction. Some people love it, some people hate it. Some people say they hate it and then spend 2 hours reading it anyway. But as a business, Reddit has something extremely valuable: intent. People go there with real questions. What should I buy? What broke? Which stock are people arguing about? Which phone is worth it? Which software actually works? Which car has the problem nobody tells you about? That kind of behavior is valuable because it sits close to decision making. Reddit's latest quarter showed daily active users up in the high teens, revenue up close to 70%, advertising revenue growing even faster, gross margin above 90%, and operating cash flow around $300 million. That is not just a cute internet forum anymore. That is a platform learning how to monetize. And the reason investors got excited is not only growth. Growth is good, but profitable growth with low capital needs is different. Reddit does not have to build a massive factory to add another community. It does not need a new data center for every new advertiser. It can improve targeting, ad tools, onboarding, translation, search, and AI-assisted ad creation without needing the kind of physical spending that chip and cloud companies are now dealing with. That is why the business can scale so beautifully when it works. But here's the counterpoint. Reddit is not Meta, not yet. Meta has global advertiser relationships, years of ad optimization, huge reach, Reels, messaging, Instagram, Facebook, WhatsApp, and an ad engine that has survived privacy changes, competition, and regulation. Reddit has upside because it monetizes far less per user, but it also has to prove it can raise monetization without damaging the culture that makes the platform valuable. That is the balance. Reddit can be a mini Meta in the making, but if it pushes too hard, users will feel it, and users always get the final vote. If you're successful, share your success story in the comments so others can stay motivated. Now let's talk memory, because this is where the market's imagination really changed. For years, memory stocks were treated like classic cycle trades. Prices go up, profits explode, supply catches up, prices fall, investors get hurt, and everybody promises they will be more careful next time. Then AI data centers showed up and changed the demand picture. SanDisk just reported a quarter that looked almost unreal. Revenue was roughly $6 billion, almost doubled from the prior quarter. Gross margin jumped into the high 70s. Data center demand surged, and the company guided the next quarter toward roughly $8 billion of revenue. That is not a small improvement. That is a cycle turning into a stampede. Micron is telling a similar story. Its recent quarter showed revenue nearly tripling from the prior year, with DRAM, NAND, high bandwidth memory, and every business unit reaching new highs. So what changed? AI changed the customer. A consumer might delay buying a phone if prices rise. A data center customer trying to train models, run inference, or support AI applications may not have that luxury. If memory is the bottleneck, they pay. If storage is tight, they sign long-term agreements. If high bandwidth memory is scarce, they fight for supply. That is why memory pricing can move so quickly. But again, don't confuse a powerful cycle with a riskless cycle. Memory is still memory. Supply will respond. Customers will negotiate. Margins that look amazing today can normalize later. So yes, the boom is real. But the investor has to ask how much of the boom is already in the stock. That question never goes away. Now bring Meta into this. Meta's first quarter was strong. Revenue was around $56 billion, up roughly a third from last year. Ad impressions rose around a fifth. Average price per ad rose low double digits. Family daily active people were around 3.5 billion. The advertising machine is still very much alive. But Meta is also spending like it wants to build the future with both hands at once. The company lifted its full-year capital expenditure outlook to roughly $125 to $145 billion, partly because of higher component pricing and partly because of data center needs. That is a massive number. And this is why investors are conflicted. Meta's core ads business is beautiful. But AI, superintelligence, robotics, glasses, reality labs, custom chips, and data centers are all expensive, very expensive. Then Meta acquires a robotics intelligence startup, and people ask, what exactly is Meta becoming? I think the answer is that Meta does not necessarily want to build the robot body. It wants the intelligence layer. It wants models that understand people, space, interaction, movement, and behavior. In other words, the robot brain. That could be brilliant. Or it could be another long, expensive road with uncertain returns. And that is the Meta debate, in one sentence. The cash machine is clear. The future bets are not. Now step back and look at the full picture. Apple is showing device demand and cash flow, while warning that components matter. Nvidia is showing unbelievable scale, but expectations are heavy. AMD is getting rewarded for AI potential, but valuation needs discipline. Nebius is moving from raw compute toward inference economics. Reddit is turning attention and intent into cash flow. SanDisk and Micron are showing memory is now strategic. Meta is proving ads still fund everything, even while AI spending gets bigger. This is not random. This is the AI supply chain becoming the market's new operating system. And underneath all of it is the jobs debate. Jensen Huang has been pushing back against the idea that AI simply destroys work. His argument is that AI automates tasks, but companies that become more productive often become more ambitious. They try bigger projects, they write more code, they build more products, they hire for different problems. I think that is mostly right, but not complete. AI can create new jobs over time and still hurt some workers right now. Both things can be true. A software tool can make a team more productive and still reduce demand for certain entry-level tasks. A company can grow faster and still restructure. A technology can be good for the economy and painful for individuals caught in transition. So don't treat AI as heaven or doom. Treat it as a productivity shock. Productivity shocks create winners, losers, and a whole lot of confusion. As investors, the job is not to cheer blindly. The job is to separate the companies that turn AI into cash flow from the companies that only turn AI into press releases. That means watching margins, watching capital spending, watching customer concentration, watching user growth, watching pricing power, watching whether the story is supported by numbers, not just excitement. Because the market is changing. Compute is becoming industrial infrastructure. Data centers are the new factories. Chips are the machines. Memory is the bottleneck. Platforms are the distribution. Users are the demand. And cash flow is still the scoreboard. So the next time a stock jumps or drops, don't just ask what happened today. Ask where it sits in the stack. Does it own users? Does it own compute? Does it own memory? Does it own software? Does it own pricing power? Does it own something the AI economy cannot easily replace? That is the framework. And if you use that framework, the market starts to look less chaotic. Not easy, never easy, but clearer. And one more thing. Don't let one green day make you careless. And don't let one red day make you cynical. The real edge is not predicting every candle. The real edge is knowing what business you own, why the market is paying attention, and what would prove your thesis wrong before the crowd figures it out. That sounds simple, but in a market this loud, simple is usually what saves you from doing something stupid. Again, this is for education and market discussion only. I'm not your financial advisor, and I'm not telling you what to buy or sell. Use this as a starting point, do your own research, and make decisions that actually fit your risk, your timeline, and your life.